Hello, Charles Cowap here with the first of 3 short video presentations on the valuation of agricultural tenancies, art or artifice. Artifice because these valuations rarely come up as being based on actual transactional requirements. Agricultural tenancies do, however, have to be valued from time to time for taxation, for compensation for compulsory purchase, and sadly sometimes in the circumstances of divorce, family partnership dissolutions, or indeed the death of a partner in a tenancy. First of all, we're going to have a look at the legal background to why these valuations are required, look at the situation facing a tenant farmer who may be going on to lose part of his farm on compulsory purchase, for example. In the second of the 3 videos, we'll be looking at some examples from case law on how to value agricultural tenancies, and in the third and final one, we'll try to pull those lessons together. The legal basis for these valuations then is our first point of call, and there are 2 aspects that we really need to look at quite closely today. The first is the Compulsory Purchase Act, and Section 20 of the 1965 Compulsory Purchase Act tells us that an annual tenancy, of the sort that is enjoyed by many traditional farm tenants, is entitled to compensation for the value of the unexpired term or interest in the tenancy, in other words how much longer the tenant might be expected to be there, any just allowance which might be made by an incoming tenant to an outgoing tenant, so that might be areas like tenants' improvements and so on, any other losses or injuries, the loss of grown crops in the ground, and areas like that will be covered here, and finally severance and injurious affection. More of that a little later. The other area that we need to look at is the background to tax valuations. Tax valuations have a very long history, but we can go back, for instance, to Section 38 of the Finance Act of 1975, which couches the definition of market value for tax purposes in pretty similar terms to the Inheritance Tax Acts and the Taxation of Chargeable Gains Acts. They say that the price for an asset should be the price which it might reasonably be expected to fetch in the open market at the time of the valuation. That can envisage not only a hypothetical sale, but a hypothetical vendor. These are really important practical points for the valuation of farm tenancies, because in practice most such tenancies have a ban on assignment and subletting. In other words, there is not an open market in which the tenant can sell or assign or sublet his interest, but the careful development of tax law on valuation aspects over the years has led to the possibility of imputing not only a hypothetical vendor but a hypothetical sale where there are restrictions in real life on the transfer of assets. This principle is highly relevant to the valuation of agricultural tenancies, but it's also been relevant to the transfer of shares in family companies, which may be subject to similar bars on sale or transfer in different circumstances. In looking at the cases that we'll see in the second video, it's also important that we understand the role of the upper tribunal lands chamber. This used to be the lands tribunal before the general reorganisation of the lower and upper tier tribunals. It's important to understand that the lands tribunal is the main forum for the resolution of disputes concerning statutory valuations of one sort or another. However, it is not a court of precedent, unlike the Court of Appeal and the Supreme Court. Therefore, we can't really regard its decisions as binding precedents. They are, however, very persuasive, particularly where the Lands Tribunal or the Lands Chamber has had to resolve competing arguments between 2 different valuers. We'll see some examples of that in the second of the 2 videos. Looking at farm tenants and compulsory purchase, then a farm tenant, especially under an agricultural annual tenancy, may be faced with one of 2 ways to go. But to set the scene for this, an annual tenancy is not actually entitled to receive a notice to treat following the serving of a compulsory purchase order. That means that in principle there is no entitlement to compensation for the shorter term tenants under the General Compulsory Purchase Compensation Code. So the procedure available to acquiring authorities is either that they can acquire the freehold from the landlord of the farm and then serve notice to quit on the tenant on the grounds that the land is required for non-agricultural development. This would typically be under one of the incontestable grounds, case B, in the 1986 Agricultural Holdings Act. If they need entry sooner than their completion of the freehold acquisition, they can also go on, once a notice to treat has been served on the superior interests, to serve what's called a notice of entry under Section 11 of the 1965 Compulsory Purchase Act. In practice, most farm tenants will probably find themselves being faced with a notice of entry rather than a notice to quit. But in the rare cases where a notice to quit is served, it's very important that the tenant's position is considered carefully. Compensation for notice to quit will follow the 1986 Act requirements, so there will be a disturbance payment, but under Section 60 that is 1 year's rent automatically and up to 2 years' rent if further loss can be proved. Because the disturbance is arising in the face of a notice to quit for non-agricultural development, there's also an entitlement to an additional 4 years' rent as compensation for the double inconvenience of that. In the normal way, the tenant can claim for tenant right, and that would include extending the claim to any claims for improvements which have been granted with the landlord's consent, depending on the terms of that consent, and possibly for tenants' fixtures if the landlord is willing to take those too as well. On a notice of entry, however, the compensation code is different. Section 20 of the 1965 Compulsory Purchase Act tells us that the tenant is entitled to the value of the unexpired term or interest on the tenancy. That normally means that the claim under Section 20 is more generous than the claim under the 1986 Act, and for that reason the tenant faced with a notice to quit has a choice. Let's have a look at that choice. The tenant's choice is set out in Section 59 of the 1973 Land Compensation Act, and basically it tells us that a tenant who receives a notice to quit can elect to be compensated as if he had received a notice of entry. How is this to be done? There are very few formalities, but the few that there are important. The tenant must exercise his option under Section 59 in writing, and he must do it before he gives up possession. Furthermore, the option, once exercised, cannot be revoked. So how should we make the choice between the two if we do receive a notice to quit? Here are some considerations. The basis of compensation under Section 20 of the 1965 Act includes the value of the tenant's unexpired term or interest. Section 48 of the 1973 Land Compensation Act tells us that in doing that we should have regard to how long the tenant would have been in occupation of the farm in the absence of the compulsory purchase scheme. For this purpose, we're looking in most cases at a life expectancy on the tenant farmer. However, beware the particular circumstances surrounding the tenancy. For instance, in the Scottish Lands Tribunal case of Anderson and Moray District Council, it was clear that Mr Anderson would have lost his tenancy due to non-statutory development within a few years in any case, and the effect of that was to limit the length of his unexpired term or interest, and therefore to limit the value of that unexpired term or interest. The tenant is also allowed the just allowances which would be made by an incoming tenant for any improvements and things like that that will be taken over, and he's also allowed compensation for any loss or injury sustained by the tenant. Typically this covers the areas of tenant right compensation and disturbance payments for loss of the land as well. Severance and injurious affection is another area for which compensation is available. Important changes were made in 1991 in the Planning and Compensation Act of that year. Until that time, severance and injurious affection was restricted solely to that suffered in the tenancy itself. Since 1991, that claim can be extended to any other land held by the tenant farmer with the tenancy. So if, for instance, there is contiguous owner-occupied land, then that too could be included in the claim for severance and injurious affection if there has been a loss of value. The case of MOT and Pettit in 1968 at the Lands Tribunal is significant in this regard. It led to a change in the law where it became clear that it was the effect of the whole scheme, leading to severance and injurious affection, rather than just that part of the scheme on the land lost by the tenancy, which should be taken into account. There is also retained, for tax reasons, the reorganisation payment which arises under Section 60 of the Agricultural Holdings Act 1986. This payment is based on 4 times the rent over the land which has been lost. However, that is seen as being a doubling up of the value of the tenant's interest, and an important principle of compensation is that you can't be paid for the same thing twice. However, the 4 years rent payment is tax-free compared with the payment for the value of the interest, which may be liable to capital gains tax. In order, therefore, to preserve this small tax-free element of the compensation, the value of the tenant's interest is calculated, the amount of the reorganisation is calculated, and the reorganisation payment is then deducted from the value of the tenant's interest in order for the reorganisation payment to be made separately. That reduces the taxable amount on the value of the interest and retains the tax-free element of the reorganisation payment. Let's have a look at a comparison of the tenant's compensation between notice of entry and notice to quit. And here we have Section 20 of the Compulsory Purchase Act. We've got, as I've said, the value of the tenant's interest. We've got the severance and injurious affection. We have the actual disturbance costs, which are paid without any maximum, subject to proof of loss. We've got tenant right, and we've got the additional 4 years rent. If we look over to the other side of the slide, we can see that, firstly, there's nothing like the value of the tenant's interest. The impact of severance and injurious affection is only dealt with by a reduction of rent in respect of the retained land. Actual disturbance costs are restricted to a mere 1 or 2 years rent. There is a ceiling, therefore. Tenant right works in the same way, and the additional 4 years rent works in the same way, subject to it being deducted from the first item, the value of the tenant's interest. So, on the basis of those comparisons, 1 to 5, it would look as if it would always be worthwhile opting to be compensated under Section 20, as if notice of entry had been served. The one reservation here is that there's a very restricted right to enlarge notice of entry to take the whole farm. This brings us into contact with the blight areas of compulsory purchase, where we have to be able to demonstrate that the retained land is quite incapable of physically being farmed. That's a very difficult hurdle to pass, and therefore not a practical route as far as most claimants would be concerned. However, when notice to quit part of a farm is received, it is a relatively straightforward matter to enlarge that notice to quit from part of the farm to the whole of the farm. On the whole, then, it's going to be preferable to opt as if notice of entry had been served, rather than to stick with the notice to quit, which has actually been received. But do note that you can't go the other way. So if you receive notice of entry, you can't opt to be treated as if you'd received notice to quit instead. There are a few situations in which you'd want to, but the point is worth making. Turning to the tenants of farm business tenancies, their entitlement to compensation depends on whether they're eligible to receive notice to treat or not. If they're a short-term tenancy, year-to-year, or running on from a fixed-term tenancy as a year-to-year tenancy, they're not eligible for a notice to treat, and they're compensated in the ways I have described already. If they are eligible to receive a notice to treat, then we must look to the General Compensation Code to find the way forward for their compensation. So who is eligible? Notice to treat can be served on any lessee or tenant, but it doesn't have to be served on any tenant who has an interest no greater than a year or from year to year. So fixed terms more than a year to run, notice to treat must be served. Less than that, it does not have to be served. That brings us to the end of our first of the 3 videos where we have looked at the legal background to the eligibility of farm tenants for compensation on compulsory purchase and the legal basis of farm tenancy valuations for tax purposes as well. I hope you found that useful and look forward to you joining me for the second of our 2 videos.